Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to have you join us today. We're starting off with a story that's been making waves in the financial community, the debate between ETFs and mutual funds. Both are popular investment vehicles, but they have some key differences that can make one more suitable for your needs than the other. Recently, we've seen a surge in interest in ETFs, or exchange-traded funds, which offer investors a way to trade a basket of stocks, bonds, or other assets throughout the day. This flexibility can be appealing to investors who want more control over their portfolios. On the other hand, mutual funds, which price once per day, can provide a simpler, more straightforward investment experience. One of the main advantages of ETFs is their tax efficiency. Because they don't have to sell securities to meet investor redemptions, ETFs can be more tax-friendly than mutual funds. Additionally, ETFs often have lower fees and no minimum investment requirements, making them accessible to a wider range of investors. However, mutual funds have their own strengths. They're often the investment vehicle of choice for 401k plans, and they can provide a hassle-free way to invest in a diversified portfolio. Mutual funds also offer automatic investing options, which can be a great way to dollar-cost average and reduce the impact of market volatility. So, which one is right for you? The answer depends on your individual investment goals and needs. If you're investing in a taxable brokerage account and want more control over your portfolio, an ETF might be the way to go. On the other hand, if you're investing through a 401(k) or prefer a simpler, more hands-off approach, a mutual fund could be a better fit. We'll continue to explore this topic and others like it on the Riskwiser Zone, providing you with the information and insights you need to navigate the complex world of finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our show, and we've got a fascinating story to share with you. Today, we're diving into the world of housing and economics. Recent reports indicate that single-family housing starts have taken a dip, with a 15.4% drop in overall housing starts. Now, some might see this as a cause for concern, but others argue it's a necessary correction to prevent an undesired backup in new home inventory. As we explore the numbers, we notice that building permits for single-family homes rose 0.6% last month, which could be a sign of cautious optimism. However, multi-family housing starts took a significant hit, plummeting 41.6%. It's essential to consider the context and the potential factors driving these trends. Economists point out that the inventory of unsold new houses on the market remains elevated due to weak demand. This pullback in single-family housing starts might help prevent an undesired buildup in inventory. The National Association of Home Builders projects a national housing shortage of around 1.2 million homes, which highlights the need for policy adjustments to address the supply side of the equation. Meanwhile, import prices increased 1.9% in May, driven by more expensive fuels and capital goods. This rise in import prices could have implications for inflation and monetary policy. The Federal Reserve is expected to keep interest rates steady, but the possibility of future rate hikes remains a topic of discussion. As we navigate these complex economic waters, it's crucial to maintain a balanced perspective. We must consider multiple viewpoints and avoid jumping to conclusions. The relationship between housing starts, import prices, and monetary policy is intricate, and we'll continue to monitor these developments closely. For now, it's essential to recognize that the economy is constantly evolving, and we must adapt our understanding accordingly. As investors and consumers, it's vital to stay informed and make data-driven decisions. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to dive into a fascinating topic that's been gaining attention in the world of business and finance. You might have heard of Mark Cuban, the billionaire owner of the Dallas Mavericks and a prominent figure on the TV show Shark Tank. Recently, he's been advocating for a rather interesting idea. Every worker should receive company stocks as part of their compensation package. Cuban's argument is rooted in fairness and the concept of shared success. He believes that when everyone owns stocks, the results are better, citing his own experiences with multiple companies. In fact, he's paid out bonuses to every employee who has been with him for over a year whenever he sold a business. This approach has yielded impressive outcomes, with staff receiving significant payouts, such as the $35 million they received when he sold his majority stake in the Dallas Mavericks. The idea is that equity should scale with pay, so if a CEO receives stock awards worth 50% of their $10 million salary, every employee should receive stock worth 50% of their own compensation. This would mean a front desk worker making $40,000 would get $20,000 in equity rather than the same dollar amount as the CEO. While this concept may seem appealing, there are practical objections to consider. Stock awards only work if the company does well, if employees can actually sell their shares, and if they remain employed long enough for the awards to vest. Moreover, some employers might hold down base pay to offset the cost of providing equity, potentially replacing guaranteed wages with a risky ownership stake. Despite these concerns, research on voluntary employee stock ownership plans suggests that they can have a positive impact on workers' financial well-being. The National Center for Employee Ownership estimates that roughly 15 million American workers participate in such programs, with over $2 trillion in assets. A study found that workers at companies with employee stock ownership plans had a median retirement balance more than double that of workers at similar non-participating companies. So, what does this mean for your money? While Cuban's proposal would require significant changes to become a reality, the underlying logic applies today. If your employer offers an employee stock purchase plan or equity grants, it's essential to understand the terms and participate if possible. If you already have stock options or restricted stock units, make sure you comprehend the vesting schedule and tax implications. As we conclude today's Riskwiser zone, remember that investing in the stock market always involves some level of risk. However, by being informed and making smart decisions, you can navigate these risks and work towards achieving your financial goals. That's all for today's Riskwiser zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.